Welcome to Iron Financial. I'm your lead analyst. Look, our mission here is really straightforward. We're here to help you forge a stronger portfolio. We do that by cutting through all the market noise and hammering out the cold, hard truth. Today, we're putting commercial metals, that's ticker CMC, right under the microscope. Now, this company just dropped an earnings report that, if you just glanced at it, looked like it was built from solid steel. I mean, rock solid. But the market reacted like it was a house of cards in a hurricane and it just got blown over. So, what we're going to do is the heavy lifting for you. We are going to stress test the very foundation of this company, we're going to examine every single beam, and we're going to figure out if this is a structure worth investing your hard-earned capital in, or if it's one that's about to collapse. Let's get to work.
All right, so here's our blueprint for today's deep dive. First up, we're going to tackle what we're calling the market paradox. Basically, why did a report that looked so strong get absolutely wrecked? Then, I'm going to lay out the bull case for you, and we'll examine the actual steel frame of the company's financials. After that, my colleague, our resident market skeptic, he's going to jump in and expose the bear case. He's going to be looking for any and all foundation cracks that the market might be seeing. From there, we'll get into the precast gamble. This is a massive strategic move they're making that could really define their future. And then, of course, we deliver the final verdict. By the time we're done here, you are going to have a crystal clear framework to make your own call.
So let's set the scene, right? Commercial Metals comes out with their Q2 numbers, and operationally, man, they look incredibly powerful. We are talking about a massive triple-digit jump in their core profitability. Not only that, but they actually outpaced what Wall Street expected on revenue. And then, to put a cherry on top, they announced a really significant dividend increase. I mean, that is a direct signal from management that they have extreme confidence. In any rational world, you see these headlines, you expect the stock to pop. These are the kinds of numbers that reward shareholders and send a stock soaring. By all accounts, this report was forged from high-grade steel.
Whoa, hold on a minute. Forged from high-grade steel? You know, the market is the ultimate judge, right? And it delivered a verdict that was absolutely brutal. The stock didn't soar, it got hammered. It dropped almost 4% on the day. You have to understand, the market isn't stupid. It's a forward-looking mechanism, and it's screaming at us that there is something else going on here, something just below the surface. It's sniffing out a weakness that you're not going to find in the pretty press release headlines. So let me ask you this. If the news was so good, why did investors, the people with actual skin in the game, with real money on the line, why did they run for the exits? That is the paradox, and that's what we need to solve.
And that's exactly what we're going to do. You're absolutely right to be skeptical. That's why you're here. That's why we're here. But listen, before we can start diagnosing any cracks, we have to inspect the main structure. We have to see what we're working with. So we're going to do the heavy lifting now. We are going to examine the steel frame of this company, number by number, fact by fact. Look, the market can be emotional, it can be volatile, but the raw materials, the numbers themselves, they tell the true story. So let's get into the hard data and see just how strong this company's core really is. And we're going to start with its engine, profitability.
114%. Just let that number sink in for a second. 114%. That's the year-over-year jump in their second quarter core EBITDA. It came in at a massive $297.5 million. Now, this isn't some minor uptick, this isn't a rounding error, this is an explosion in operational profitability. You know, EBITDA, earnings before interest, taxes, depreciation, and amortization, that's the purest measure you can get of a company's raw earning power. And a jump of this magnitude tells you that the core business isn't just stable, it is a high-performance engine, and it is just throwing off cash. Cash that can be used for growth, paying down debt, and shareholder returns. This, right here, is undeniable proof of serious operational strength.
Okay, so from that powerful engine, let's move over to the balance sheet, because a powerful engine needs a fortress built around it to protect it. $1.7 billion. That is Commercial Metals' total available liquidity. Think of it as their war chest. It's made up of over $500 million in cash just sitting on hand, plus whatever they can draw from their credit facilities. In a market this volatile, and in a cyclical industry like steel, liquidity is absolutely everything. It is your shock absorber. It means they can weather economic downturns. They can fund strategic acquisitions without having to take on bad debt, and they can operate from a position of immense strength, not desperation. This isn't some company living paycheck to paycheck. This is a company with a fortress-like balance sheet. It's built to last. Now let's look at the top line, the revenue. Wall Street, the experts, they expected CMC to bring in about $2.09 billion. Well, they came in at $2.13 billion. They beat that estimate by a solid $40 million. Now let's be totally clear here. Is this a world-changing, knock-it-out-of-the-park blowout beat? No, it's not. But in this market, with the headwinds we're seeing everywhere, the direction is what matters. They're still outperforming what people expected. They're finding ways to grow and sell more than the analysts predicted. To me, that shows resilience. It shows disciplined execution. Beating on the top line, even by a little, is a fundamental sign of a healthy business that has products people want.
And look, if you won't take my word for it, just listen to the people who know the company best. We're talking about its own management and its board of directors. You simply do not approve a double-digit dividend hike unless you are supremely confident about the road ahead. This quote, it says it all. They have confidence in their financial strength. Okay, but here's the crucial part. They have confidence in their future cash flow generation. They are signaling to the entire market in the clearest language possible that the underlying structure of their business is sound and it is built to last.
And that signal, it doesn't just come in words. It comes in the form of cold, hard cash returned directly to you, the shareholder. An 11% increase in the quarterly dividend. It's up to 20 cents per share. This is a direct reward for investors who stick with them. It's the tangible result of that 114% EBITDA growth we just talked about, and it's backed up by that $1.7 billion in liquidity. Action speaks so much louder than press releases. And this action is shouting from the rooftops that the company is healthy, it's profitable, and it's committed to its shareholders. From where I'm sitting, the steel frame of this company looks absolutely rock solid.
A strong frame is completely and utterly useless if the foundation is riddled with cracks, and that's what the market is screaming about here. You can sit there and admire the shiny steel beams all you want, but if the concrete underneath it all is crumbling, the whole structure is eventually coming down. The market isn't emotional, it's a discounting mechanism. It is looking right past the headline you like, and it's pricing in the problems that you seem to be ignoring. So let's pour some cold water on these nice-sounding numbers and see exactly where the real stress fractures are starting to appear.
Here it is. This is the whole story. The central conflict, the reason the stock got punished so severely. Yeah, okay, they beat on revenue by a little bit. That's nice. But, and this is a huge but, they missed on earnings. The top line grew, but the bottom line, where it really counts, was a disappointment. Wall Street lives and dies by profit. Earnings per share, or EPS, that is the ultimate measure of a company's profitability for its shareholders. A miss here is a major red flag. It suggests that while they're bringing money in the front door, they're struggling to keep it from flying out the back. It could be a cost management problem, it could be margin compression from rising input costs, maybe it's integration issues with their new acquisitions. Honestly, whatever it is, it's a critical failure that completely overshadows a minor revenue beat.
And let's be really clear, this wasn't a near miss. It wasn't like they missed by a penny. The numbers on this chart show you just how deep that crack really is. The analyst consensus, that's the average of all the Wall Street estimates, was for $1.30 per share. CMC delivered just $1.16. That is a 14-cent miss. That's more than 10% below what was expected. In the world of earnings reports, that is a significant gap. It tells you, plain and simple, that the company's profitability engine is not running nearly as efficiently as the market believed it was. This is the crack in the foundation. This is what triggered the trading algorithms and caused the big sell-off. It's really that simple.
And another thing, this isn't just a CMC problem. You can't analyze a building without considering the ground it's built on, and right now the entire steel sector is on some very shaky ground. Sector scanners on the day of the report, they were flagging peers like Cleveland Cliffs and ArcelorMittal moving down right along with them. The median move for the entire sector was a drop of about 2.6%. That's not a coincidence. And this isn't some one-day blip. You look at the Q1 metals report from a big bank like PNC, and it points directly to soft home building in both the US and in China. And here's the kicker. They see further weakness in demand for iron and steel. So CMC is not immune to these powerful macro headwinds. The whole industry is facing a potential downturn.
And finally, just look at the company's recent track record. This isn't a one-time fluke. The market has been telling us for months that it's deeply skeptical of CMC. This data here from Stock Titan it's damning. On March 25th, they announced the very same dividend increase you were just celebrating as a sign of strength. And what happened? The stock fell 2.2%. In late January, they get some nice PR, some recognition for sustainability. The stock fell 1.9%. And going back to their Q1 earnings report, another release that had positive headlines, the stock plummeted 3.6%. There is a clear and recurring pattern here. The market consistently, and I mean consistently, punishes this stock, even on what looks like good news. That indicates a deep, fundamental skepticism about the company's future that you just cannot afford to ignore.
Okay,
Okay, you've pointed out some very serious risks, and that pattern of selling on good news is a legitimate concern. I'll give you that. But the crucial point is understanding why that skepticism exists, and I believe it all centers on the company's biggest strategic move in years. This brings us to what I'm calling the X factor, the company's massive investment into precast concrete. This is their attempt to build a bold new pillar for the business, to diversify away from just pure steel, and to create brand new avenues for future growth. It's a forward-looking move, and it's designed to reinforce the entire structure for the long term.
And if you look at this timeline, it shows this wasn't some snap decision they made in a panic. This has been a deliberate, multi-stage strategy. It started way back in September of 25 with the acquisition of a company called CP&P. That was their ticket into this new market. Then, in January of this year, they laid out their whole plan, exactly what they expected this new platform to contribute to their bottom line in terms of future EBITDA. And that brings us right to today. This quarter, March 2026, this is the first major earnings test for this newly integrated business. This is the first time we get to see if their strategic blueprint is actually sound, or if the costs of putting it all together are already causing stress fractures in the balance sheet.
You call it a pillar. Bar chart calls it a massive precast gamble. And you know what? I think gamble is exactly the right word. Look at the language here. Yes, sure, it has transformational growth potential, but the risk is absolutely immense. They are absorbing new companies like that CP&P and another one called Foley, and they're doing it in a weak market. Just think about the massive upfront costs, the challenges of integration, the potential for a culture clash. They are taking on a huge, complex project at the exact moment their core market is showing serious signs of weakness. It is a high-stakes bet, and that EPS miss we talked about, it suggests they might be stumbling on the execution right out of the gate. This isn't a pillar yet. It's a pile of wet cement, and frankly, no one knows if it's going to set properly.
All right, we've laid out the blueprints, we've examined the steel frame, and we've inspected the foundation for every possible crack. We've debated the company's boldest new expansion. Now it's time to weigh all the evidence. We're going to forge all this information into a clear, actionable thesis for you. The question, at the end of the day, is simple. Is commercial metals a golden opportunity that's just disguised by some short-term fear? Or is it a value trap that's waiting to spring on unsuspecting investors? Let's summarize the opposing arguments one last time.
Okay, the bull case is forged in the undeniable operational strength of this company. Let's just recap the cold, hard facts. First, core EBITDA didn't just grow, it skyrocketed 114%. That is pure, unadulterated operational power. Second, they are sitting on a fortress of a balance sheet with over $1.7 billion in liquidity. That means they can withstand any storm the market throws at them. Third, they beat revenue estimates in a tough environment, which proves their resilience. And finally, management put their money where their mouth is with that confident 11% dividend hike. These aren't opinions, these are hard numbers. The core structure is sound, period. And the bear case is built on the significant cracks that the market is clearly hammering on right now. Let's not forget them. Number one, the critical miss on earnings per share. The bottom line is what ultimately matters, and they failed to deliver. Number two, the stock has a clear, documented history of falling on good news, but shows a deep-seated market distrust. Number three, the entire steel sector is under pressure from serious macroeconomic headwinds. And number four, their big strategic move, the precast gamble, is adding a massive layer of execution and integration risk at what might be the worst possible time. These cracks are real, and they're dangerous.
So, here is my verdict. The market is overreacting. It's getting fixated on a single data point, that EPS miss, and it is completely ignoring the overwhelming evidence of operational and financial strength. Right now, fear is driving the price, not the fundamentals. The core business is a cash-generating machine. The balance sheet is a fortress, and management is rewarding shareholders for their patience. This disconnect, this gap between the underlying strength of the company and the negative sentiment in the market, is creating a potential entry point for long-term investors who have the steel to withstand some short-term volatility. The strength is real.
And here's my final take. The cracks are simply too deep to ignore. There's an old trading adage, don't fight the tape. And the tape on CMC is telling you to be extremely careful. That EPS miss is a material warning sign about profitability. The persistent negative reaction to any news is a massive red flag from the market, and the sector headwinds are a real threat that this company cannot escape. This has all the hallmarks of a classic value trap. A stock that looks cheap on paper, but just keeps getting cheaper for very good reasons. My verdict is that caution is the strongest material you can build your portfolio with right now. Respect the warning signs. So that's our breakdown. two completely opposing views, and both are backed by the data. On the one hand, you've got a company with incredibly powerful operational metrics that's being sold off by a fearful market. On the other hand, you've got a stock that is showing clear warning signs that the smart money is taking very seriously. And this brings us to the central conflict that you, as an investor, have to face. So we're going to leave you with that final question. Is the market's pessimism a true warning sign of a deep, foundational weakness, or is it a compelling buying opportunity in disguise? We've given you the framework. Now it's your turn to do the heavy lifting and forge your own path. Thanks for joining us here at Iron Financial.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.